Welcome to the video. Today we are going to challenge a common beginner question. How do you pick a good stock? The core message is that most beginners should not start with stock picking at all. Instead, you should secure your financial foundation, understand market mechanics, and use a simple, diversified index fund strategy, ideally within tax-advantaged accounts like a Roth IRA. We will cover why this approach works, how to set it up, what common mistakes to avoid, and when stock picking might make sense later.
Let us begin. First, here is the central thesis. Instead of spending time trying to identify winning individual stocks, beginners should focus on building a strong financial foundation. That means clearing high-interest debt, building an emergency fund, and then using diversified, low-cost index funds inside tax-advantaged accounts, such as a Roth IRA. This gives you exposure to thousands of companies and reduces single-stock risk while allowing compounding to work over years and decades.
Next, here is our roadmap. We will start with why stock picking is a common trap for beginners. Then we will cover the essential foundation, clearing high-interest debt and building an emergency fund. After that, we will move into the set and forget index strategy, including total market and total world index funds like VT. We will use several diagrams to visualize the process. We will also discuss when stock picking could make sense later in your journey and test your understanding with brief quizzes. To begin, we need to debunk the myth that picking the right stock is the path to quick success. Large bodies of evidence show that most professional active managers do not consistently beat their benchmarks over the long run, especially after fees and taxes. For beginners, the time invested in early valuation work often has low payoff compared to learning market mechanics and building a diversified portfolio. Holding individual names exposes you to idiosyncratic risks that can permanently impair your capital. Diversification across thousands of companies reduces single company risk and allows you to capture the aggregate performance of the global economy. Now, let us visualize the foundational steps. The flowchart starts by assessing whether you have high-interest debt, which typically means credit card or similar debt, with rates around 6 to 8% or higher. If you do, the priority is to pay it off, because the guaranteed return from eliminating that interest usually beats market expectations. Next, build an emergency fund sufficient to cover 3 to 6 months of essential expenses. Once those are in place, open a tax-advantaged account such as a Roth IRA if you qualify. Otherwise, use a taxable brokerage account. Then, select a low-cost total world or total market index fund, for instance VT. Automate your contributions monthly to remove decision fatigue. Rebalance annually, or when your allocations drift beyond set bands.
Finally, the most important step is to stay the course through both bull and bear markets.
Before we continue, a brief disclaimer. This content is educational and not personalized financial advice. Your situation may differ, and you should consult a qualified, fiduciary financial advisor before making major financial decisions. Moving on, here is a straightforward implementation plan. First, audit your finances by listing all debts, their interest rates, your monthly expenses, and current savings. Second, eliminate high-interest debt before investing. Third, build a 3 to 6 month emergency fund in a safe, liquid, high-yield savings account. Fourth, open a Roth IRA if you qualify or a low-fee brokerage account.
Fifth, purchase a diversified total world or total market index fund such as VUNT. Sixth, automate contributions each month and set dividends to reinvest. Seventh, ignore day-to-day market headlines and conduct a more thorough review annually. Finally, rebalance only when your allocations drift beyond predetermined thresholds to maintain your risk profile.
Next, let us clarify what an index fund is. It is a fund that passively tracks a market index by holding the same securities in the same weights. A total world fund, such as VT, holds thousands of companies across developed and emerging markets, providing broad diversification. Costs are crucial because fees compound against you. Low expense ratios leave more of the market return in your pocket. Diversification reduces the harm from any single company failing. Over time, compounding returns accumulate, and time invested is generally more important than trying to time market entries and exits. Now, let us look at two simple starting allocations. The first option is 100% in a total world fund such as VT, which is simple and highly diversified. The second option is an 80-20 split between VT and a broad bond fund for investors seeking to reduce volatility. The exact choice depends on your risk tolerance, time horizon, and ability to sleep at night during downturns.
Furthermore, let us compare stock picking with indexing. Stock picking requires deep analysis, ongoing monitoring of individual companies, and the acceptance of higher single-name risk. It is difficult to beat the market consistently after costs and taxes, and the process can be time-consuming and emotionally draining. By contrast, indexing provides broad diversification, aims for market-level returns with low fees, is easily automated, and typically results in lower maintenance and lower stress. And when implemented in tax-advantaged accounts, it can also be tax-efficient. Additionally, here's why fees matter. Assuming a 7% gross market return, a low-cost index fund with a 3 basis point fee nets about 6.97%, turning $10,000 into roughly $75,300 over 30 years. A 1% fee reduces the net return to 6%, which compounds to about $57,400 over the same period. That difference is nearly $18,000, and the gap widens with higher contributions and longer horizons. These are approximate figures for illustration. Quiz time. The question is, what should most beginners prioritize before picking individual stocks? Option A. Building a diversified index fund plan and financial foundation. Option B. Timing earnings announcements. Option C. Learning advanced option strategies. Option D. Chasing hot stock tips on social media. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A. Building a financial foundation and using diversified index funds should come before trying to select individual stocks. This approach captures market returns, reduces risk through diversification, and leverages compounding with minimal maintenance. Next quiz. The question is, what benefit does a total world index fund like VT primarily provide? Option A. Guaranteed outperformance of the market. Option B. Concentrated bets on a few tech stocks. Option C. Broad global diversification across thousands of companies. Option D. Elimination of all investment risk. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video.
The correct answer is C. A total world index fund such as VT provides broad global diversification by holding thousands of companies, which reduces single company risk while tracking the overall market. Moreover, this timeline compares two investors. The early investor contributes $200 per month from age 22 to 32 and then stops, allowing the money to compound. The late investor begins at 32 and contributes the same monthly amount until 62. Despite contributing for far fewer years, the early investor can end with similar or even greater wealth because compound growth had more time to work. The key insight is that starting early is often more powerful than contributing larger amounts later. Finally, if you still want to pursue stock picking, do it only after mastering indexing and demonstrating consistent contributions and disciplined rebalancing. Then, study financial statement analysis, valuation techniques such as discounted cash flow and multiples, and risk management including position sizing and exit rules. Develop a written thesis for each investment, run risk checks, and be prepared to iterate as new information arrives. This path requires substantial time, patience, and ongoing learning. As a quick reference, here is a Markdown-style checklist summarizing the steps. Pay off high-interest debt, build a 3 to 6 month emergency fund, open a Roth IRA or brokerage, buy a low-cost total market fund, automate contributions, and rebalance annually. The simple growth formula serves as a reminder that compounding works over time. Finally, example allocation bands show when to rebalance if allocations drift beyond 5%. To recap the essentials, beginners should avoid stock picking and focus on diversification. Clear high-interest debt and build your emergency fund first. Use tax-advantaged accounts such as a Roth IRA where possible, and automate contributions.
Choose low-cost total world or total market index funds, for example VT. Stay the course, rebalance periodically, and only consider stock picking after mastering the fundamentals of index investing. In summary, stock picking is not the right starting point for most beginners. Build your foundation by eliminating high-interest debt and securing an emergency fund. Adopt a simple, global index approach that you can automate and rebalance. Compounding rewards those who start early and stay consistent. If you still want to pick stocks, do it later, and only after mastering the basics. Thank you for watching. If this video helped you, please like it, share it with a friend who is starting to invest, and subscribe for more evidence-based, simple investing content. I would love to hear your approach. Are you going with a total world fund like VT or a mix with bonds? Share your thoughts and questions in the comments.